So first of all, when it comes to protective stop placement, I want to quickly explore some of the issues about protective stops in general. And I also want to look at the concept of volatility as it's understood in the financial markets, because the two are related. Then I'll get into some detail of the stops I use and how they work in the current highly volatile market conditions. So, protective stops. As we all know, there are no perfect solutions in trading, and inevitably it comes down to a recurring choice between two things. And in the case of protective stops, these two choices is kind of a case of picking the least worst option, the one we can live with. And protective stops are always going to be a trade-off between whipsaw and lag. So let me explain what I mean by whipsaw and lag. Whipsaw occurs when stops we're using are too close to the price. And I have here on this little chart, you can see we have a trailing stop on here, which is close up to the price bars on this. And as you can see, we've been kicked out of this trend here because the stop was too close. And the issue with the whipsaw is that if we're stopped out here, we might miss this re-entry and then we might miss the rest of the trend as it develops. And the other issue with whipsaw is we require a lot of time at the screen, because once we're kicked out here, we need to get back in if we want to get the rest of this trend. And if we're part-time traders, we might not be able to do that. So the other issue then is lag. And what this means is that the stops are too far from the price. And this is the exact same chart I've shown here, but I have the stop set much farther down. And if we're going to trade a lag dependent strategy like I have here, that means we have to scale down our position, which is the amount of money we have in a trade, in order to accommodate this drawdown. Because if we're in a trade up here, in order to set our risk management at a point where we're stopped out down here, then we have to reduce the position size to such an extent that the entire trade might not be worth the effort. The other issue with lag we have is if we do face a drawdown, let's say at where we're trading at the moment and our stop is down here, we have to take this big drawdown and then we also have to take the exit. So it's like we're getting slammed twice in the one go. So there's a number of common methods that traders use to deal with this whipsaw lag trade-off, and I'll just go through 4 of them quickly here. The first one is people use a set dollar amount for their trade. So they make an entry, then they say, well, I'm going to risk $200 in every trade. So they calculate what that would be, and that's where they place their stop. The other one is they go a set percentage below their point of entry. And let's say, for example, they say, look, I'm prepared to give up 5% here. So they calculate what 5% would be. If they enter at $100, put the stop at $95, and that's how they're calculating the stop. Another popular one that I see speaking to traders is and by the way, these are all daily swing trades on the long side. So if you're entering here on this bar, for example, your entry, let's say you got a bad enough entry here close to the closing price, and this is your previous support. You're going to put your stop under where you believe this support level is. But of course, these support levels are very spongy. It's hard to know exactly where they are. And to be on the safe side, you're going to go well below where you believe this level of support is. And again, you're taking on a lot of lag because your position size will be low in order to accommodate. The fourth and final one I see is where traders put a percentage of their account below the entry, and this is similar to a percentage of the trade. But in this case, they say, look, I'm going to risk 5% in every trade, and that's how they go about it. Now, there are a number of issues with these 4 methods for selecting protective stops, because they do not take into account the unique history of the instrument you're trading. It's kind of a one-size-fits-all, but that doesn't really work. Because most of these stops are based on the volatility of the trader, and by that, I mean his emotions, not based on the volatility of the ticker they're trading. It takes no account for the current conditions of the instrument we're attempting to trade. The other issue is, of course, what worked yesterday with these methods may not work tomorrow. So what's the solution to this? Well, in my experience, The best solution is a dynamic protective stop based on the unique realized volatility of an instrument we're trading. So, two things to explain. In this context, I'm using the word dynamic to mean something which is constantly adapting to changing circumstances. And here we have an example. This is a trailing stop, the red line under these price bars. As you can see, the stop was loose enough to avoid these pullbacks, but at the same time to catch a trend which developed. But it was also tight enough to get out on time with the maximum amount of profit before we had this sell-off. And this is a stop based on realized volatility. So what exactly is realized volatility? In the markets, we generally encounter two types of volatility. And the first one, and this is a phrase that always comes up, is the implied volatility measured by VIX. Now, this is a volatility index based on 30-day options pricing for the S&P 500 organized by the CBOE, often known as the fear gauge. You'll hear it mentioned in the media as the fear gauge. That's technically not accurate, but that's what they're talking about, the VIX. There are other volatility indexes, not just the 30-day VIX. You can get a 9-day, 3-month, and a 6-month. And what this implied volatility really means, it's what options traders think is going to happen in the equity market. In other words, it's implied in the price. The other type of volatility we're looking at in the market, and this is the one we're interested in, is realized volatility. This is a measure of how much price moves up and down the price axis. You can see here with this red arrow. And if you think of this like a lie detector or a seismograph that measures earthquakes, you know it's going along fine, and then our guy in the room tells a lie and the detector starts scraping furiously up and down. And this is what realized volatility is. It catches a shift between periods of low and high volatility. We had a very low volatility trending market before February, and then in the sell-off, we're now moved into high volatility. This lie detector, the seismograph, is scratching furiously at the moment. Realized volatility looks at the range of the price bars. And this is important because it includes the gaps. And that's one of the features of a volatile market. And we'll get to that in a minute. Realized volatility is measured using average true range, or ATR. And this is something that was introduced by J. Wells Wilder in his book, New Concepts in Technical Trading Systems. And average true range, ATR, is calculated by using the current high of the bar we're on, the current low, and it also takes into account the previous close. And that's how it's pulling in these gaps that exist between bars, which is very important when it comes to trading volatile markets. So with implied volatility, if you recall, it's what options traders think is going to happen in the equity market. Realized volatility is what actually happened, and we're now measuring it. So what's the calculation for realized volatility as expressed by average true range? Here we have 3 price bars. On the current bar, we have the current high, we have the current low. The difference between the two of these is the range of the bar, the high minus the low. But what average true range does in its calculation is it includes the previous bar's close into the calculation. So what's happening here is when we have a close and then an open, the gap between the two, this is accounted for with average true range. And that's what we need to capture volatility. So let's look at protective stops then based on volatility rather than the 4 common methods we saw earlier on. And these are based on ATR, and they're what I use all the time in my charts. All instruments I trade, all strategy, all timeframes, these volatility-based protective stops. And again, they're a dynamic solution, a solution that constantly adapts to changing situation. Because of this, they're a tailor-made protective stop for every chart we trade. And the stop molds itself to suit the unique history of the ticker we're trading. The stop automatically adjusts for recent volatility, and it also automatically adjusts for the time frame we're trading. The true range, if you remember how true range incorporates a gap between 2 bars, opening gaps. This is the important bit, and this is one of the features of volatile markets, and it's what we're seeing a lot of today. And when we get onto some charts here in a minute, I'll show you some gaps and how these ATR-based stops incorporate those gaps into their calculation. ATR is calculated from an exponential moving average rather than a simple moving average. An exponential moving average includes the most recent data, or I should say it gives more weight to the most recent data when it's calculating the moving average line. And that will pick up on a change in volatility that little bit quicker, the exponential will, than the simple. These stops are suitable for day trading, swing trading, and trend following. As Mark mentioned already, I am primarily a trend follower on weekly and daily charts. I also like to do some daily swing trading. And on occasion, when the situation arises, I will also do some day trading. But I'm using these volatility-based stops on all three of these main trading styles. They work best on instruments which trend, and those would be equities, ETFs based on equity indices, and also on futures. They work on the long side and on the short side. They can be plotted on price bars and volume bars, which are very useful, particularly when you're trading futures. And most importantly, they're not perfect. You know, as I said, there's no perfect solutions in trading. It's just about picking the best you can. And I can honestly say these are the best protective stops that I have found. I've worked with a lot of stops and I've seen a lot of different scenarios. I have yet to find a better type of stop that adapts to any market than these volatility-based protective stops. Okay, so let's go on to the calculation method. Now, I'm going to go through some settings on this, but don't worry about the figures because if you want to email me after this presentation, I'll be more than happy to send you a copy of this presentation and you can just go through the settings at your leisure. So if I'm going through these a bit quickly, don't worry about it. You can look at them later. Oh, that's just the market getting ready to close. So what we're looking at here are two things. We're looking at the look back period on which we're going to calculate our exponential moving average. And we're looking at the ATR, the average true range distance. And that's either going to be the upside because our stop will be above the price if we're trading short. And then our stop will be below the price. So the ATR distance either above or below the price bars based on a look back window, this exponential moving average. So you can also do this by manually calculating the ATR. And you can use this with ATR channels or Keltner channels. Depending on the trading platform you're using, you may or may not have access to these. And even some of the freely available platforms online will provide you with ATR channels and Keltner channels. There can be a slight difference in the calculation, but usually not very much. All you need to do is plot 3 or 2 ATR channels on any chart, on any time frame, preferably equities and futures, as I said. And the difference between 2 ATR channels, that is your average true range. Make sure these are set at 1 each, and then obviously it just calculates what 1 average true range is based on the look back window that you have set your exponential moving average at. The kind of default out of the box for a lot of these is 13 or 14. I like to use a 21 period exponential moving average. So once you've manually calculated your average true range here, and let's say you want to enter on this bar, let's say you're taking a daily swing trade here to the upside, you think this instrument is going to go up. You then set your stop below this, the set amount of average true range that you're going to use below the bar. And that's how you manually calculate these if you don't have access to an instrument. Now, I use a custom proprietary indicator on TradeStation to plot these stops. And we'll come to that in a minute. But if you don't have access to that, if you can't import that type of indicator to your platform, that's the method for manually calculating them. Here are the settings, and these are my preferred settings. Over the years, I've tried a lot of different ones, and I've kind of settled on these. I switch between these, or I often have 2 stops on a chart, and I go with the one that's closer to the price. So the first one is a 63 period look back, a 63 EMA, and 1.5 ATR down. And the second one is a 21 period EMA, that's a look back window, and a 1.75. On a daily chart, 63 EMA is going to be 1 quarter, 63 trading days, and the 21 then obviously is going to be 1 month. So like I say, don't worry about these settings. You don't have to frantically write them down or figure it out. I'll give you a copy of the presentation later. So let's look at entering a trade. Now those settings, if I can just go back, those settings I've showed you, it's okay, we'll press on. Those settings I showed you are more or less when you're in a trade and you want to run a trailing stop under it. Here we have the entry for a daily swing trade. And what I like to do is, based on the calculation, I get a half ATR below the low of the price bar in which I'm entering. I'm entering here, not a very good entry, very high up in the bar at the close, but just for convenience, I've put it there. And the difference between your entry and this stop, that's your risk. And that's how I calculate it using that ATR. Okay, then on a trailing stop, let's say I'm in the trade here, I put my initial protective stop on, and then it starts to move in my favor. If it's a swing trade, I'm going to scale out some of the profit as it moved up onto the upside, and then I'm going to trail a stop under the balance of the position here. So once this trailing stop, which is now 1.5 ATR below the low of every price bar, once that moves above the initial protective stop, then I switch to this trailing stop. And I just let it run. I just stay with it, continue to follow it the whole way up until at some point the price pulls back, hits the stop, and I'm stopped out. So you can use this on daily swing trades. You can use this on daily and weekly trend following positions. You can also use it when day trading. The only thing that changes is the time frame. Okay, let's go over then and have a look at some charts, because as we know, that's the theory of what I've shown you of how to work with protective stops. But as we all know, it doesn't work out like that in the real trading environment. Before we came on, I had a look at the Fidelity order book, and I wanted to see some today's popular stocks. So let's just start in longer time frames and go down to the shorter time frames. So let me just go across here to charts and just confirm. Are you seeing this, Mark? Yeah, I think we should be good.
Yes, now I am.
Yeah, thanks. Okay, I'm on a Mac here, switching over and back. I'm running there's the market closed. Perfect timing. Okay, so this is a weekly chart. As I said, this is TradeStation. This is the US version, TradeStation Securities. This is build 10. This is a weekly chart. On here, I have elder impulse bars. These change color. Green is for bullish conditions, red is for bearish, and a blue then is when we have a change in the current conditions. That's a standard MACD histogram in the middle, and this is volume on the bottom with the moving average. Very simple chart. This is what I like to do. I like to have a minimum of indicators. Don't use a lot. On the chart here, I have two trailing stops. This red line, this is for trading on the long side. As you see, it's under the price. And on the short side, it's above the price. These are the ATR trailing stops I'm talking about. This is Tesla, featuring a lot in the news recently. And as you can see here, since back in we got in the trend here, kicked off sometime around last November, this trailing stop on a weekly chart caught this trend perfectly. And then we were stopped out when we had the sell-off here because of the coronavirus. Stopped out in the middle of the chart. When we opened in that week, we got a perfect fill, so that was okay. We currently we're back in this here at this point based on the low for this week. Bear in mind these are weekly charts, so this bar won't finish until the close tomorrow on Friday. And as you can see, this pretty much caught it perfectly, and that's why I like to use it. Microsoft, another one that's very popular. Back here in December of last year, nice washout of the lows, 1 bar washout, closed higher. That would have been a perfect entry on a weekly trend following position. And you can see this trailing stop caught the trend the whole way up along until inevitably we were stopped out here again. We did gap down here at the open. This was on Monday 24th, February 24, if you remember, when things started to get serious. We gapped over that stop. We would have taken a small loss there, more than we had allowed for in our risk management, but still we'd picked up enough profit on the trend to make up for that, I'm sure. What I kind of want to draw your attention to on this one is, if you look here at this point, and this was in June 7, we had a low here of 119.01. The trailing stop was 118.08. We were still in this, what's that, 90 something, 93 cent. So we have a stop here that it's loose enough to catch this entire trend if a trend develops, but it's also loose enough to avoid this pullback here, this flatlining here, and the pullback here. But at the same time, it's tight enough to get us out on time and miss this sell-off. Now, looking back on it, we know that this is recovered and it's nearly trading back where it was. But when we sold off down here, we didn't know that at the time. It's very easy to trade in hindsight, but unfortunately, we can't trade in the past. We have to trade in the present, and that's how it kind of works out. Let's drop down to daily charts. And I'm going to look at these on the long side and on the short side. Again, caught Microsoft nicely there. The one I want to go back to is Tesla. So we're looking at the same instrument here. We've seen it on a weekly basis. Now we're looking at it on a daily basis. And you can see, if we look at the right-hand side of the chart here, that the stop has adjusted perfectly for this daily time frame. Got in, whether this is a trend following position we're in. We had 1, 2 pullbacks on this. We've had our gaps up. We had quite a gap today on earnings. We gapped up, raised, sold off again. These gaps in this Tesla ticker, they're incorporated into this price, and this will adjust accordingly. You'll also notice on the pullbacks, like we had here and again here, see the way the trailing stop flat lines? Because this is kind of like a one-way valve. When we're trading on the long side, it follows the price up, and it's based on the low of this bar. From here to here is 1.75 average true range for this bar, based on that look back period. And this is set at a 63 period look back, this particular one. And then when the lows start getting lower, it just flatlines. We do not want to give back the profit. Now, if we came down and we were stopped out here, then so be it. But it happened that we weren't, and we went on. And again, when the lows started to get lower here, we flatlined, and we've picked up again here in the last few days. Another one I want to look at is Amazon. This one is being traded a lot, getting mentioned. We're in here, very nice. Similar situation. We've had these pullbacks. Look at this bar here. We had a low here of 2279.66, and our trailing stop was 2277.29. Just kept us in at that point. What's that? Just over $2.30, $2.37, I think. What I also want to draw your attention to here is the change in volatility. If you look at these narrow range bars, do you see how small they are? And they were all compressed along. Then all of a sudden we had this jump in volatility. This is like, remember the lie detector? This thing started scratching furiously straight up. Look at how the stop adjusted, followed it up perfectly. And then once it compresses and starts to pull back, the stop flatlines. So this is our line in the sand right now, 2277.45 on Amazon on a daily chart after the close of trading today. And it looks like we've gone on to make a new high. Hopefully, if you're in this position, it will go higher and the trailing stop will follow it up. How are we doing for time? I think we're okay. Let's have a look at SSO. This again is a daily chart, trend following strategy. These geared ETFs, and this is SSO, it's a 2 times geared ETF offered by ProShares. It tracks the S&P 500. So for every move on the S&P 500, this moves or is intended to move twice as much in the same direction. These geared ETFs are very popular with trend followers. However, because of the gearing, there tends to be some gaps on these, or a lot more gaps than you will get in the underlying index. And we can see here, when we had a gap down, we had this little island of 3 bars, then another gap up. That's a classic pattern. Still, but you've got these gaps, depending on whether you're long and short, these can prove difficult. Look at these gaps we have here along. But look how the trailing stop has stayed just close enough to get us out if the average range changes significantly, but at the same time tight enough to catch the stop. Perfect. And because this stop is incorporating the gaps in the calculation, it'll keep us right. Take a look at the short side here. Again, we have the same situation. This is 1.75 above the highs on this case. And as you can see, and then when we had this bounce here, this reaction rally on the S&P 500, kicked us out. Now these stops generate automatically, that when you have a sort of a reversal like this, they plot automatically. But just because it's not showing on the chart, you can still have the stop down here and you can trade it if you wish. That doesn't matter. Let's look at the short side before we go. Boeing, this is in the lose a lot. Trading this short if you can get availability on it. Right from the very top up here at the beginning of February, the whole way down. We were whipsawed out here. As I said, these are not perfect, but it caught the majority of the move, at least 2/3, maybe 3/4 of it. And when we had this very strong reaction rally, we had a low here of 89, we went to a high, that actually doubled in price, got us out before we had to take too much of a hit on that. A real short squeeze took place there on Boeing. And one final short one I want to look at is CCL, which are Carnival Cruise Lines. These are the cruise ships, which again are having difficulties because of the current situation. And once again, trailing stop on the short side, caught this nicely, and then just brought us out. It was actually knocked out on this bar here, as you can see, before we had the strong reaction rally. And since then, we're just trending sideways. Again, notice the change in volatility. Look at these little narrow range bars. This is a very indecisive instrument here. They don't know where to go up or down. A lot of making mind up going on here. Compare it to the height of these bars, this wide range bar here. This is the shift in volatility I was talking about, and this is what the stop adjusts to incorporate. We've now started up again on the long side, and we're flatlined here actually on the stop, just after today's session. How are we doing on time, Mark? Have I a minute to look at futures?
Looks like you have about 1 minute exactly.
1 minute it is then. These are futures, micro E-mini futures of the S&P 500 on the left. This is the NASDAQ, top right, Dow, Russell. As you can see, trailing stop caught all of these perfectly. If you're in the June contract of some of these, one issue here on the Russell, we were stopped out here at this point. There was an opportunity to re-enter, and we're currently trailing here. We have a bit of a sell-off, and these have adjusted well to the futures. We won't have time to show you day trading with these, but that's really a session in itself. And actually, Dr. Alexander Elder gave a class today on day trading on intraday charts. So if you get a chance to check out that recording, I think these classes are going to be recorded by MoneyShow and put up on their YouTube channel. So you should certainly check out Dr. Elder's class. So that's kind of it. I think I might wrap it up there at that point, Mark. If you have, if anybody has any questions or anything, now is the time I can answer them. If you want a copy of this presentation, please drop me an email. It's Ian, I-A-N, @murphytrading.com, and I'll be more than glad to send it along to you.